Welcome back, traders and investors. We have John Cole Scott, better known as JCS of Closed End Fund Advisors. He's a portfolio manager and a registered investment advisor responsible for the executive duties of running the business. John, how you doing today?
Doing well. Good morning, guys.
Morning, John.
So you
Or
work,
JCS. We're calling
yeah,
you
let's call it
JCS.
J. I like that,
Yeah, I like
JCS.
JCS too. I sometimes go by Triple D, so JCS is cool. We're going JCS today.
And so, little history on the firm. How's that working with your dad? Do you ever get in trouble? Does he ever give you any time out still?
Well, it's hard not to call him George at Thanksgiving dinner. I do remember the first business meeting I called him George, and the branch manager, the other firm, asked me, was it weird calling my father that? I said, again, not so much at work because you have to have a great working relationship that's somehow separate from the personal one if you're going to be able to work with family.
I worked with my dad for years in construction. My dad had a construction business, and we'd butt heads a lot. When I was a little kid, it was fine. Obviously, you could just boss you around. But as you get older, then you start thinking you know something, and then you start butting heads with your dad, and that can be a rough thing actually working with your dad when you think you know as much as he does, even though you never do.
All right, so let's just introduce our investors a little bit. Just what are closed-end funds and how do they work?
So closed-end funds are the original investment company listed in the New York Stock Exchange in 1893. They are really defined as three main things. One, permanent capital, which means they're born or created like stocks, like LinkedIn and Facebook were created on one IPO. Same process for a closed-end fund. They have active management, which means they are trying to do a strategy that's based on analyst and outperformance and alpha typically, and some very unique strategies based in the sector. And then the third piece is they trade at market prices on the listed exchanges during the day, which means they produce a net asset value like open-end funds, which are their younger cousins, but they trade at market prices which are often different than net asset value, which often creates discounts of 1 to 5% at certain times. Premiums of 1 to 5% and discounts of 5 to 15% are not abnormal amongst the wide group of closed-end funds.
Okay, why? And this is always a question I have because I do trade closed-end funds. I don't really invest in too many, but I trade them every once in a while. And I do notice, and I sometimes look at the net asset values and be a fund trading like 15% below its net asset value. Why would they do that? Like, why would a fund trade 15% below of what it's actually worth?
Well, there's a little bit of we're not sure, but the best answers my career has come up with for over a decade is that first off, the fact that they can trade at a discount has to allow for some natural discount to be considered normal, which is why you'll see, discounts kind of a 3 to 5% for an average closed-end fund over long periods of time be a normal level because there's always that risk of a wider discount. Secondly, when you're competing on yield and performance, then sometimes your performance lags, or sometimes the market is acting differently, and people are out of favor with what you're doing, and so therefore people require a little bit of a discount because they feel like they need to have some protection from what's going on.
Okay.
What's interesting is as long as there are a couple of factors, you have protection from really wide discounts for almost all closed-end funds, and that's the activist. Activists generally get involved around 12 to 13, maybe 14% discounts as long as they have three things. They have enough liquidity to be able to do what they want to do. And sometimes they surprise each other with which funds have enough liquidity to do their job. Second, a trackable ETF to hedge out the risk of the portfolio actually going down because of the market versus discounts changing. And that helps you protect the really bad downside of risk.
So basically, that activist investor will come in, buy these closed-end funds at a discount, short some equivalent, asset if it's like something close to like the S&P or whatever it is, to obviously take the market risk out of it, and then they're looking to capture that discount. So if it's down, like if it's 15% below its net asset value, they're looking to come in and capture that 15%. Is that what they're doing?
Yeah, so as long as there isn't, like, the manager doesn't own half the shares so he can block whatever they want to do, as long as that isn't blocking you or some other unique scenario, they will look to do tender offers near NAV. They'll look to do share buybacks. They'll look to do dividend increases. They've actually fired managers to try to create better performance. They even took control of a fund and became the manager of a closed-end fund that they didn't like what was going on. So it's a little
JCS now.
different. Go ahead.
I was just going to say, okay, so we got this. Is there any ones that you're eyeing right now? Now, do you advise your clients that when you see something trading at a 10 or 15% discount to NAV, do you advise your clients to get active in this and maybe buy these ones?
Well, we do have a model where about half of the focus is on activist preemptive activity. A lot of the good stuff actually closed in the last 2 weeks, as in the discounts have narrowed enough in 2 weeks that it's challenging right now to see what's going on. You've called us at a really interesting time in the closed-end fund land. The January effect, we're right, I think, 2/3 of the way through. Discounts widened on these funds 2, 3, 4% wider than we'd seen all year up until 2 weeks ago. We've rallied, 2, 3, 4, 5% on closed-end funds, which aren't the most exciting investments, in 2 weeks on relative pricing because of people recovering from tax loss selling and people buying really cheap things beat up because they had really bad intra-year performance.
Right. Now, do you have a couple that are still, if we're looking out there as investors, do you have a couple that you're eyeing right now that you think are cheap relative to the NAV, or they all have closed up?
Cheap the NAV there. I mean, I still think that, and again, most closed-end funds, they're not home run vehicles. They're singles and doubles.
Yeah.
You trade them when you see opportunity. You hold them to see what happens. But one thing I like about General American Investors is it's a large fund, very liquid. It's still at a 13.5 discount. It's a U.S. equity fund. The manager has been a little bit more aggressive than some of his peers, which has paid off performance-wise. His net asset value year-to-date through yesterday is up over 30%. So it's like the market, and yet closed-end funds are usually, because they're often for retired folks, less aggressive. This has been matching the market, yet you're still getting 87-cent dollars to see whatever happens going forward. The discount a year from now could be 13 discount, and you still could have done very well. You don't have to close a discount to make money, but it's possible upside.
Yeah, obviously, if the market moves up, you're still going to capture that. But sometimes maybe the market could be flat, and if that discount closes, you could still make money on these things too. It's always interesting. Where do we find, I'm just interested because I trade these closed-end funds too sometimes. Where do we find information on, is there a website we can go to, or is it your website we can go to where we can find?
There's a couple of websites. I'll start with the free websites because people generally start with free, and then if they need more help, they find the paid stuff later. Probably the widely recognized site. They're both bits of Morningstar data. There's Nuveen's CEF Connect or CEFconnect.com. Morningstar has built out a great
Connect?
Yeah, CEF Connect, all one word, .com. Morningstar has built out a closed-end fund site that's gotten more robust in the last 2 years. There's an up-and-coming site called CEF Analyzer. That's CEFANALYZER. That's actually run by an ex-Google employee that's trying to have fun giving Morningstar and CEF Connect a run for their money just on programming and advancement. And then there's a really good resource, especially for folks that have a lot of questions that need patient answers, at Morningstar's discussion forums. Their discussion forum on closed-end funds, it's mostly retired, relatively sophisticated closed-end fund guys that answer lots of questions all day long, and they're not FINRA licensed, so they're allowed to. So, unlike, I can't get very involved there because of, how we're registered.
Looking at this GAM, I mean, it's supposed to be a, kind of a less risky vehicle, and I don't mean to catch you off guard here, but back in November, this thing really took a haircut. It gapped down over a point. Is that just a rebalancing of the funds, or that was back on November 13th here? So you're looking at a pretty conservative investment. That was a pretty big drop. Do you know what?
Yeah, that was a $1.89 dividend it went at.
Okay, all right. So
the challenge, you bring up a hugely great point that so many people miss. When you look at a closed-end fund chart, make sure you're looking at a total return chart, because the average closed-end fund as of last Friday yields about 7.2%.
Right.
Which
so
means if you let's say a lot of funds yield 8%, roughly 2% a quarter. If you don't think about that 2% a quarter into the market price, you're going to look at a lot of charts and go, oh, this thing lags. It's horrible. because the S&P yield is 5% lower, and so this looks like it's an outperformer when it may or may not be. That's a great question.
Yeah, because if it's 7 or 8% coming off of it all the time, and the market's up 8%, that thing will look flat if it's just paying out the earnings, obviously, just as dividends to their shareholders.
I just had one other question for you
Yeah.
too. Now closed-end funds. I mean, you're not recommending that. You're recommending a percentage of your portfolio in closed-end funds, right? You're not just your customers are not just, this is just a part of asset class that they put in their portfolio, correct?
Well, I'll tell you that is a normal perspective. I'll tell you the two people that tend to hire our firm. They're the people that need income levels blending between 7 and 8, and they don't have many other choices, and they get comfortable with the closed-end fund nuances, which are less inefficient, more volatile. Like the average muni bond fund has a market price volatility almost the same as the S&P 500. So you can't buy a closed-end municipal bond fund and think this is a boring investment. What you're buying is exposure to that asset class at a higher yield, but knowing you're stepping into more volatility. So that volatility, some people say, oh my gosh, it's too risky, I can't handle it. Well, the point is, look at some of these charts, look how the funds handle bad months, and if you can't handle that as an investor, then yes, you shouldn't be here. The other folks that hire us were already into closed-end funds, they drank the Kool-Aid, they love them, and they decided that they want to spend more time traveling or with their grandkids, so they basically turn it over to us. So we realize closed-end funds probably are a 10 to 25% position for most normal portfolios, but the people we talk to, it's typically 70 to 90 to 100 because they've already stepped into this is where they want to live. The key is closed-end funds are a structure, not a sector. They have their strengths and their weaknesses, but if you understand them and you don't go in blind, then you typically can come out with great results.
Do you have some funds? Because I know I trade these things sometimes, and sometimes a few of these funds can be pretty illiquid. Do you stay away from the illiquid ones and just kind of focus, your investors onto the more liquid ones? Because obviously, if the thing's got, a 2 or 3% spread, which I think some of these things have, then just by selling out, and trying to get out of your position, you could lose 2 or 3%, right?
Generally, when we screen, we like to have $500,000 in liquidity, which is 30-day trade volume times market price. But for firms that have the ability to access outside traders, there's about 5 or 6 traders in the U.S., and we use 2 of them presently, they can find full days trading volume on the phone. So I say closed fund liquidity can be stealthy. I didn't know it existed 2-3 years ago. We found these providers. They tell me when they've got buyers and sellers, when there's imbalances. They work with activists. They work with institutions, with endowments, with firms like us. So there's days where you can actually have a full day's trading volume done over the phone in 2013, which I'm told is rather rare in the rest of the capital markets.
So basically, you'll call up, and then you'll find liquidity on the other side of some other institution or something that wants out. They'll cross this trade and then go off exchange with the print. Is that kind of how it works?
Yeah, so basically, the phone negotiated. I say I want to buy at 11.14. Their client agrees, and then you see it hit the plotter. It's a public trade, but it was done, negotiated through the first system we ever had. The way trades used to happen on the telephone.
Yeah, interesting.
The good old days.
I would say limit orders are important if you don't have that access. Not held orders if you got access to them to your custodian are very useful to hide what you're doing. And to think of a 2 to 4 day window as your timeline if you've got serious assets. And serious assets, I'm talking north of $5 to $10 million, in closed-end funds. So it's very few individual investors, and probably north of 25, 30 million for advisors, institutions.
So the individual investor trading, 1,000 shares or 500 shares or 2,000 shares, they're probably fine to go find their liquidity on the exchange in most of these vehicles. Then
and just
they can, and then the key is limit orders, patience. Knowing that if you find a really inefficient price to give up 40 basis points because you want it now versus wait to see what happens. You have to decide that 40 basis points, is worth taking to meet the bid-ask spread.
Gotcha.
That's an investor decision.
And you mentioned the term there, Dennis. I don't even know. You're probably too young to remember or ever heard this term, but not held order. In basic, Dennis, you've heard of that kind of order. I mean,
Yeah,
you can
it's still,
apply.
yeah.
Yeah, I mean,
But
I
explain that
yeah,
actually, and
I
maybe
haven't heard
JCS
that
can.
since I've been back on the trading floor, and that's been over 20 years. And basically, when you give a broker, in this instance, a broker for a closed-end fund, a not held order, basically what you're telling them is, you want this price, but you're not going to hold it to them. So if it
Yep.
basically you're giving the broker the opportunity. Sometimes on not held orders, I remember down on the floor, someone comes in with 400 or 500 S&Ps. If you show that price on the floor, people are going to dance around you. But if you give someone a not held order, you're saying, hey, I want this average price of 11.14. If you get some at 11.18, some at 11.12, 11.13, I'm not going to hang you. It's a not held order, and it's actually a very, very smart way to work the orders, especially in illiquid instruments.
It is, and the way I put it this way, closed-end funds are 85% held by retail investors. Muni bond closed-end funds are 96%. I'm probably now 95% held by retail investors. So you've got a lot of sometimes sophisticated, but often short-term, irrational, waiting to get back to even. You don't want to, just less focused, diligent because it's not their job. Traders, and so you really need to have more flexibility in your trading and more patience in your trading than simply I have to be in or out today.
Okay.
That's how we view, ETFs as exposure vehicles, and we view closed-end funds as inefficient and income-oriented vehicles.
Okay, just to finish up the interview, I know there's a lot of different closed-end funds out there, and you're following a lot of different things. A lot of things go into your investment calculations and your models. But are there sectors right now that are catching your attention that you would have people just keep an eye out for, or is it all just based on where things are trading in relation to the net asset value?
Another great question. So if you're familiar with John Templeton, he was one of my father's, really investment gurus and mentors. He says when there's blood in the streets is when you buy. So two of the areas, it's recovered a good bit, but REITs got crushed second half of 2013. There are a couple of well-run REIT funds. Cohen & Spears has some. There's a few others out there that just they give you diversified active management. You've got some reasonable discounts. One of them, let me check, it's yesterday's discount. Closed yesterday at still a 10 discount with RQI. It's a liquid U.S. REIT fund that we do have exposure to.
Okay.
Discounts narrowed, but it's still cheap historically, and it's a way to gain cash flow and upside. So REITs, I think, are optimistic. Optimistic for MLP funds because it's a growing part of our sector, master limited partnership, our energy infrastructure. And those things have a tax advantage dividend as well.
Okay, John, thank you very much. John Cole Scott, better known as JCS here in Benzinga land here. Thank you very much for coming in. We definitely got an education here in closed-end funds. It's always good to talk about different sectors and different ways to approach the market. I appreciate you taking the time out this morning to join us, and hope you have a good new year. And we'd certainly like to have you back on in January.
I'd love to be back on, and we have our quarterly research call the second Wednesday. People can find it on our website, cefadvisors.com.
Okay, thank you.